So for the tutorial today, I was going to talk about interest rates. So we already had a tutorial about some of the basics of the fixed income market, terminology, the concept of duration, things like that. So now I'm going to talk more about forecasting interest rates. And the way I like to think about how to forecast interest rates is to think about the yield curve of interest rates. So the yield curve is essentially the structure of the interest rate curve across different tenors. So if I share my screen, I'll be able to make that more clear for you. So I'm going to use Bloomberg here. So if I go to the WB function, it shows you interest rates across the world. So US 10-year interest rates are 1.55. Interest rates at Canada, 10 years, 1.48. If I go to curves, this shows you the interest rates at different tenors or maturities. So a 2-year bond in the US gives you 1.16% interest. A 5-year gives you 0.83%, 10-year gives you 1.55, and a 30-year 2.27. And if you graph this, so if you press this little button here, this should pop up. So this is kind of the yield curve. So as you kind of expect, the further out you go, the interest rate goes up, which is, so you have an upward sloping yield curve. So it's a steep yield curve. And I talked in my last tutorial about terminology around steepening and flattening and so on. Now the question is, why is the yield curve steep? You know, why are interest rates at 10 years higher than they are at 2 years or at 1 month? So why is the curve steep? And you know, from a kind of the kind of the framework to think about this, the way I like to think about this is there's 2 reasons why interest rates go up over time. One is that people could expect that short-term interest rates are going to be higher in 5-year time compared to in 1 year's time. So the way you can think about the 10-year interest rate is that it's a succession of short-term interest rates. So it's the 1-year interest rates for this year, and then it's the 1-year interest rate next year, it's the 1-year interest rate the year after, the 1-year interest rate the year after, and then you kind of throw it all together and you end up with where the 10-year rate should be. So it's 10 1-year rates added up together. So that's kind of the path of short-term interest rates over time. And what drives short-term interest rates? It's what the Fed's doing, the Fed's policy rate. So the Fed controls short-term interest rates. So if the curve is going up, that tells you that the market is expecting the Fed over time to be increasing interest rates. So that's one reason why 10-year interest rates could be higher than short-term interest rates. And from a kind of a finance theory perspective, there's something called the pure expectations hypothesis, which says that the entire slope of the curve reflects expectations of where short-term rates will go. So it perfectly, it perfectly tells you where short-term interest rates will go. So, you know, if you want to know what the Fed will be doing 2 years' time, you just look at where the 2-year interest rate is and compare it to today's interest rate, and then from that you can extract what the Fed will be doing. So that's one way the long-term interest rate could be higher than the short-term interest rate. The second reason is that you could have a positive bond risk premium or term premium or maturity premium. And this is the idea that actually there could be another reason why interest rates are higher on longer maturity bonds than shorter term maturity bonds. It's that when you hold a longer term bond, you're taking on some additional risk, because if you just buy short-term interest rates and every year you just keep buying short-term interest rates, that's different from holding something for 10 years. You know, you're just taking more risk by just holding something for 10 years. So that's called the risk premium or term premium. There's different names for this. I like to use term premium. And so the idea there is that by holding the longer the maturity of the bond, the more risk you're kind of taking, outside of what the market expects the Fed to do over that time period. And from a theoretical perspective, to take the extreme, if you believe that interest rates follow a random walk, which means that your best guess of where interest rates will be in the future is tossing a coin, so it's random, then if you believe that, then the entire slope of the curve reflects term premium. That it doesn't reflect expectations of where short-term interest rates will go. If you believe that markets or interest rates follow a random walk. Now, in practice, the market doesn't fully go into the pure expectations hypothesis, nor does it fully go into the random walk camp. It's somewhere in between. So the yield curve or term premium reflects some combination of expectations of where interest rates will go and term premium. So now let me kind of delve a bit more into this idea of term premium. Now I've got a spreadsheet here. So what I've done is I've downloaded some estimates of term premium. There's kind of the KW and the ACM premium, which you can get on Bloomberg and a Macrobond and other sort of databases. And what the way people kind of calculate term premium over time is that you can kind of do some what's called affine modeling, where you basically use all the different parts of the curve and you run some kind of principal component analysis on it. And then from that, you can derive where you think term premium is. You can supplement that with surveys. So what you can do is you can say, we'll kind of look at some kind of combination of different parts of the curve. Plus, we'll look at actual surveys of where do people think short-term interest rates will be in 10 years' time. Then when you kind of combine them all together, you can come up with an estimate of term premium. So the KW term premium, KW, I've got a note here, which is kind of the original source. This is these are all publicly available, these measures of term premium. So this one, the KW stands for Kim and Wright, which is the name of the authors, but I've got the link here and I can send it to you. This explains the three-factor term structure model and his paper where they explain it, how they come up with it. But in essence, if you look at the orange line, so this is the KW, term premium index, what you can see is that term premium was around 2% or 1.5% in the 1990s, which means that even if you believe the Fed would do nothing over the next 10 years, the 10-year interest rate will be 2% higher than current interest rates because term premium, because of various factors, people demand earning at least 2% more to hold a 10-year bond than holding a short-term bond. Now, since the 2010s onwards, term premium has gone to zero, which means that, somewhat strangely, over this period, the 2010s, this is kind of a very unique and strange occurrence where people are saying, actually, to hold a 10-year bond or to hold a 1-year bond, I don't want to get paid anything extra. There's no term premium for that. The only reason why 10-year bonds should have a higher yield than 2-year bonds is because I believe, or the market believes, that short-term interest rates are going to go up over 10 years. But outside of that, there's nothing extra I have to earn to hold that longer bond, which is a strange dynamic. And more recently, term premium has gone negative, which is even stranger, which is basically telling you that not only don't I want an extra reward for holding a 10-year bond, I'm actually willing to pay extra to hold that 10-year bond. So I'm actually willing to earn less on a 10-year bond than a short-term bond because there's negative term premium. And so I mentioned earlier that the KW measure uses some kind of slightly more complicated maths to come up with this, but a more simpler version is my one here, which what I've done is this simple term premia is in essence, what I've done is I've taken a, let me just pull this up. Whoops, let me just get a better, better time period without all these NAs. Actually, let me just, yeah, okay, just bear with me for a sec. Let me just, okay, what I'm going to show is how I've come up with a more cruder, simpler version of the term premia. So what I'm going to do is, so what I'm going to do is I'm going to look at the 10-year nominal interest rate, just the 10-year interest rate that you see on the screen every day. And I'm going to compare that to a survey of long-term expectations of where short-term interest rates should go. So let me just change this to 10-year interest rates. So the orange line are 10-year interest rates. This is from 1999 onwards. So this orange line, so back in year 2000, 10-year interest rates in the US were around 6%, which sounds amazingly high, but there they were. And this data here, GT10 Gov, is the Bloomberg code for 10-year interest rates. Then I'm going to compare that to where short-term interest rates are expected in 10 years' time. And I'm going to pull that in over here. So this is kind of long-term expectations of short-term rates. And I got this data from Macrobond. I couldn't find it on Bloomberg, so I went to Macrobond and got the data from there. And there's this survey called the Professional Forecasters Survey that the Philly Fed comes up with, and they come up with those estimates. So long-term, so short-term interest rates, effectively the Fed policy rate in 10 years' time is expected to be around 2% at the moment. And, earlier, in 1999, it was expected to be 3%. And so what I said earlier was term premia, a simple way of understanding term premia is that term premia is the extra amount of yield that you get above long-term expectations of short-term rates. So a crude way of coming up with term premia without the complicated maths is to simply look at 10-year interest rates and subtract them from long-term expectations of short-term rates, just minus these two together. So I've done that, and this is the simple term premia measure, the blue line. And as you can see, it roughly follows the orange line. Beyond if you ignore this kind of the spikes, if you add a bit of smoothing, it's very similar to the KW term premia measure. And so what this tells you is that the main driver of this is simply term premia is the bond rate minus long-term expectations of short rates. So you can see these follow each other very closely. So you can come up with this yourself. And if you do some smoothing, then it will kind of reflect the term premia quite sort of similarly. Okay, I'll stop there for a sec to take any questions for anything I've said so far.
Yeah, Bilal. So what is the reason behind the term premia being negative? Is there a different type of risk other than holding a bond for a long period of time, which is reflected?
Okay, yeah, I'll go on to what drives term premia, which is kind of the next question. So let me share the screen again, and I'll just go through the reasons what drives term premia. Okay, so let me just pull up this spreadsheet, drivers. And let me, people told me before that I should zoom a bit because otherwise people can't see anything. Okay, so some of the, what drives term premia? I would say there's a few different things. The biggest, the most important in my view is inflation. So main drivers of term premia / bond risk premium. Okay, number one, the big one, inflation. So generally speaking, the higher the level of inflation, higher level equals higher term premia. And then more volatile inflation, so volatility equals higher term premia. And they're often kind of go together. Often when you have high inflation, it's also more volatile as well. So you know, if you're in an environment of low inflation and the volatility inflation is very low as well, then term premia is very low. So if you go back to the chart, if you overlaid inflation on top of this, you'll see that inflation in general has been falling, you know, and has been very stable in recent years. So if you have a belief that inflation is going to pick up and it's going to be wild, you're going to have, you know, 1 year inflation is going to be 4%, next year it's going to be 0, then 5, then 0, then term premia will really start to pick up. Whereas if you expect inflation to be stuck at 1% forever, then term premia will go down towards 0. It's not clear that will necessarily go to negative, but it will just push term premia down. So that's one kind of big reason. The second big driver is, I mean, technically the covariance between bonds and other markets, but what you could really say is the correlation between bonds and equities. So what this says is that if bonds provide, actually, let me see to make it a bit clearer so you can see it. So if bonds provide an excellent hedge in recessions, then term premia will be low. So the correlation is important. So if you have a portfolio of bonds and equities, and you suddenly enter a recession, your equities will collapse. But if bonds rally, so i.e. bond yields go down, then suddenly your portfolio does better than it otherwise would. So if the bonds provide a good recession hedge, then term premia tends to be low because you're getting this really good benefit of holding the bonds. So it's kind of like a good risk aversion safe haven asset. So it's a safe haven play. Now there are periods in history, notably in 1970s, where you had stagflation, where in a recession, you also had a bond sell-off. If that's the case, then term premia would go up a lot, because it's not worth holding that bond. So then suddenly it becomes less valuable to you. So the correlation between bonds and equities is very important. And that's why a lot of people at the moment are kind of trying to say, okay, if we're in an environment where when we have a negative equity period, if bond yields don't fall, actually go up, the correlation is switching around. At the moment, the correlation is generally still correlated in a way where if equities go down, bond yields also go down, which is, or the bond price goes up. So you could say it's kind of a negative correlation between prices, which leads to lower term premia. An excellent hedge, I should say here. But if bonds sell off when equities fall, then term premia will be high. Okay, so that's kind of the second reason. The third one, and this a lot of people focus on this, is kind of supply dynamics, supply and supply demand. Well, I would say government supply and central bank demand dynamics. So a lot of people focus on this. So what this says is, okay, if the government's going to issue a lot, so if issuance is high, and also if the maturity of the debt increases, so the government's issuing lots of long dated debt, then term premia goes up. So as an example of that, if I just go to Bloomberg, maturity, okay, yeah, this is the average maturity of US debt. This is on Bloomberg. So what you see here is, this is in months. So 64 months is the average maturity currently of US debt. So what you see is from the 2000s up until the global financial crisis, the maturity of debt started to fall. And that in general should lead to lower term premia. Then it started to increase here. That should lead to higher term premia. And now it's fallen again. It's not perfect, but this kind of is one kind of thing. But in general, the more issuance, the term premium should go up. So many people today are saying, okay, there's massive fiscal deficits everywhere. So that means there should be lots of increase in term premia. There's too many bonds being issued now. But on the counter, but if the central bank is buying bonds, then term premium falls. But the counter to that is if the central bank is always buying bonds all the time, then that will push down term premia, because in essence you have kind of a non-price sensitive agent entering into the market that's going to suppress term premia. And so if you look back here, term premium is very negative. So here you could say, although issuance was up, perhaps it was the fact that central bank was so aggressive in buying bonds that it just crushed term premia. So government supply and central bank demand dynamics are important. Then the other one, and then the other one is kind of what I would call kind of regulatory / pension fund demand. So what this is that regulations can force banks and other financial institutions to hold bonds, government bonds. And we've seen this especially since global financial crisis, that government bonds are treated as a risk-free asset, and often they get a better treatment if you hold those bonds compared to holding a risky loan. And the regulator could say banks have to hold, or insurance companies have to hold a certain number of government bonds in order to be safe. But what you're doing here is that you're effectively forcing other private sector entities to buy your bonds, which is quite convenient as well. Sometimes you can call this financial repression, is another name for this as well. So when people say, who's going to buy all this issuance and stuff, you can actually say, actually, the regulator is going to just force people to buy all the bonds. In a place like Italy, for example, you see Italian banks are huge buyers of Italian bonds. And one of the reasons is regulatory reasons, that it's very attractive for them to just hold a bond rather than something else, like a loan. The other one are pension funds. So pension funds, are constantly managing long-term liabilities. So, pension funds have to, in 20 or 30 years' time, they have to pay people salaries. So in order for them to have some guaranteed future income, they end up becoming big buyers of long-term bonds. They buy long-term bonds to ensure certain future income pensions. So especially if you're on an aging population, pension funds will become more and more bigger buyers of bonds, because they basically need to make sure that they are able to pay out people's pensions, in the next 5-10 years, if the population is aging. Now, if the population is still very young, then they can be a bit more riskier with the assets they hold. They can have a bit more equities rather than bonds, because they know, okay, we don't have to pay them up imminently. But it's kind of a life cycle sort of hypothesis there. The older you get, the more you switch from equities to fixed income to have more guarantee of income. So in the UK, for example, you see the biggest buyer of long dated bonds are pension funds, Japan as well. And that's also one of the reasons why term premia could be very low in these aging countries. And then the fifth reason is, say, foreign demand. And this is mainly through central bank intervention, often in Asia and Middle East. So this was particularly a big story in the 2000s, when China and other Asian countries were keeping their exchange rates very weak. The way they did that was that they were constantly intervening in the market to stop their currencies from strengthening. So if you're the Chinese, you want to keep your currency weak, you have to sell your own currency and buy the US dollar. When you buy the US dollar, you end up holding dollars. And what they do with that dollar is they buy treasuries. So the Chinese ended up becoming massive buyers of treasuries in the 2000s. So I can see if I can pull up a chart. China, UST, foreign US Treasury, foreign holders, China. Yeah, so this is, I think this is the right chart. Yeah, so see what you see here, this is the stock, the overall amount of treasuries that China holds of US bonds. So back in the year 2000, the Chinese held around $80 billion of US treasuries. By the time of 2010, they held $1 trillion. So they basically ended up increasing the holding of treasuries by $1 trillion in 10 years. And that was because the Chinese were keeping their currency weak. So if I overlay this with the Chinese renminbi, so what you see here is that they pegged the currency, and China was booming over this period of time. So what should have happened is dollar China should have fallen, so the dollar would buy less and less renminbi. So dollar should have weakened. But if you see that they kept it constant, and so the Chinese just had to buy more and more dollars to weaken their own currencies. Then finally, in around 2005, the Chinese realized actually it's going to get too crazy. We have to strengthen our currency. They started to strengthen it, but even then, it wasn't enough. They ended up accumulating huge amounts of reserves. Now, since 2011, they haven't accumulated that many reserves. So what that tells you is that the market forces have become more balanced for the renminbi. So it is genuinely more market driven. But in general, what this tells you is that when you get large scale foreign FX currency intervention, that leads to demand for US treasuries, or it could lead to selling of US treasuries if the intervention is the other way around. So if the Chinese suddenly have to start selling treasuries to defend their currencies, then suddenly you'll see dollar treasury selling, which will lead to higher term premia. So if it's dollar buying, then lower term premia. Okay, so to summarize, the main reasons term premia would go negative, which is what we've had recently. So we've had term premia would be lower inflation or worries about deflation, which is something we got over the last year or two. It would be if bonds would rally when equities fall, which generally has been the case. It's when you have lots of government issuance, or when you have large central bank Fed buying the bonds, which is kind of what you've had. And when you get lots of regulatory pressure to buy government bonds, which has kind of been in place since 2008. And then also if you have foreign central bank intervention, which you haven't had as much of that. So on the other way around, if you want to see the curve to steepen and term premium to pick up, high inflation volatility, less Fed buying, so Fed taper, and then more government issuance, which is what a lot of people are kind of expecting. What you'd also need to see is some kind of relaxation of regulation. That would also help term premium go up. And then also some kind of emerging market crises, which would force those central banks to have to sell their reserves. So if you get those kind of ingredients coming together, then term premium would start to go up. Now, as a strategist, our job, let me stop sharing the screen, is the way I would come up with a view on interest rates is I'd take a view on the Fed. Okay, I think the Fed is going to raise rates or not, and that's based on whatever. So then that gives me a sense of, okay, so I think this is the path of short-term interest rates over the next 2, 3, 4 years. Then I take a view on term premium. So do I think term premium is going to increase or fall? In order to work out, do I think term premium is going to go up? I take a view on inflation and the level of inflation volatility. I'll take a view on, will the bond equity correlation switch? I'll take a view on the balance between Fed buying and government treasury issuance. And then the ones at the moment, I probably wouldn't care so much about regulatory changes because I don't think there'll be anything too dramatic. And I probably wouldn't focus so much on foreign currency intervention because I don't think China is going to collapse. And China's the big player here. So the main things I would focus on would be treasury issuance, Fed buying, will they taper or not? And then inflation dynamics. Those are the key things to work out if term premium is going to go up. So that as a strategist, that's how I would go about coming up with a view. So many people today, when they have a bearish view on bond market, so they think, okay, US yields are going to shoot up to 5, 6, 7%, they would in general have a view that inflation is going to pick up. We're going to have wild swings in that. The Fed's going to taper. The Fed's going to raise rates as well. If you get all of this stuff happening together, then you really have that. Now, there are some nuances here because if the Fed does taper and they raise rates, then maybe inflation doesn't pick up. So then you've got to make a judgment call about, okay, maybe my main view is really about the Fed. It's not really about term premium then, or you could take a view that actually term premium will pick up first and then, rates will go. And, there's all these, and that's what we do as strategists then. Okay, so that's kind of the main points I wanted to relay for this tutorial. Any questions from anyone?
Bilal, quick question. So your main kind of reason for term premium works for US. It's world's reserve currency. China is in current account surplus. There's a lot more dollars. Where to park it, right? That's one way to look at it. So that way it works. But if you wanted to see term premium in other regions or EMs, how do you think about that?
Yeah, no, you could look at it in a similar way as well. So if you take, say, let's pick a country like, say, Brazil. So with Brazil, if you look at term premium, inflation, that works for Brazil. Level of inflation volatility, that still works. Brazil, in terms of the fiscal deficit there and issuance, that still works. What is less important is the currency intervention, because not many countries around the world buy the Brazilian real as an intervention currency. Now, there are some Asian countries that do. So when their reserves go up, there could be some Brazil demand, but that's quite small. So it's really the FX, the foreign central bank demand for Brazil would be a much smaller factor for term premium.
Oh, got it, yeah.
So that side is less important. Now, for Euro area, UK, Japan, the foreign FX thing is still important because they're major currencies. But then for everyone else, that's less important. And then it's all the inflation and fiscal deficits and all those sorts of things become more important.
Well, so when you talk about FX reserves and how you have foreign central bank intervention. So when they talk about, in general, when you talk about EMs piling up on foreign reserves, are they mainly held as US dollar treasuries? Is that usually the bulk of the reserves which they hold? It's probably not 100% related to this topic.
Yeah. I would say so. In general, if you take, let's say there's this imagined EM country that has like $100 billion of reserves. typically around 60 to 70% of it is held in US dollars, in a dollar asset.
Yeah.
They have to make a decision about what part of the US curve they're buying. So they could be buying 5-year bonds, 10-year bonds. Sometimes they move into the front end and buy lots of bills, those 3-month bills, and that fluctuates over time.
Okay.
Then around 25% or so is euros. And then the other like 5-10%, you know, that residual is a mix of pounds, Japanese yen, Australian dollar, and then a bunch of other, you know, so maybe a Swiss franc, you know, maybe a bit of Brazil, a bit of, you know, South Africa, but that's a much smaller amount. So generally it's the dollar is by far the majority. Then you have the euro as the next big one. And then you have all these smaller ones like the pound, maybe a 3% allocation or 2% allocation. So there's two things to understand here. One is which currencies do they hold? And then the second thing is, once they hold that currency, what part of the curve are they holding? You know, are they buying lots of 10-year bonds, or are they just putting into bills?
But they're generally bonds, which are the assets, the dollar assets which they hold are generally treasuries, bonds.
Yeah, it's almost always treasuries and bonds. Now, what some central banks do is that if they have very large reserves, they sometimes carve out a part of their reserves and put that in effect into, you know, like a sovereign wealth fund, which can then use those reserves and become more aggressive in other asset classes. Because actually, you don't have to have government bonds. You can buy corporate bonds to earn high yield, or you could buy equities, or you could, you know, so then you kind of then have a, you know, a more rigorous sort of mandate. So, but in general, when you have like this kind of standard central bank, they almost always hold it in sovereigns on government bonds.
And what it's meant to reflect is your liabilities, right? So if you're Asia borrows in dollars, they trade with the US. That's why the majority of their reserves is in dollars, where if you're Central Europe, particularly because European borrowing costs were lower than the US and you trade with Europe, you get a much higher euro share to reflect that. Which is why when they report reserves, it's really sort of the change in the euro number there you look at, because if you look at dollars, you're getting sort of big valuation effects in there.
Yeah, brilliant, thank you.
Because there's countries, right, that don't publish the currency composition of reserves. And I think that IMF used to publish it for all countries and stopped. I don't know if countries were getting upset, and the way people would proxy it was on sort of external debt and trade flows.
Thanks.
Caroline, just to understand that point, so when you say Asian countries borrow in dollar and European countries borrow in euros, that is the corporates within those countries, or central bank is borrowing?
No, I'm referring to sovereigns. So like the government of Indonesia or wherever else.
I would issue bonds in dollars to the investors.
Yeah, typically. I mean, they all issue in a variety of currencies, right? They do a bit of Japanese yen and whatever else, but the majority in Asia would be done in dollars.
Just one other question, if I could. You say you take two factors when deciding on whether the curve's steepening or not. So you take a view on the short-term interest rate and term premium. I mean, there's probably no exact answer to this, but how would you generally weight the two? Is it you generally focus on the short-term interest rate, and actually because at the moment term premium is negative or so low that you don't weight it so much? Or
yeah, no, that's a good question. I mean, in general, you know, in the last, say, 10, 15, as I showed from those charts, term premiums have been so low, it's been around zero, slightly negative, that it kind of tells you that it's really a view on the Fed that you're taking. So my thing at the moment is, you know, I'd spend, you know, a lot more time on trying to work out the direction of the Fed than term premia. At the same time, when you think you're entering some kind of new regime, which seems like we are in terms of just the scale of fiscal deficits and, you know, taper and those sorts of things, you then need to kind of pay a bit more attention to term premia as well. But in general, it's kind of a bit more on the Fed side, or what the central bank is doing. it's from a kind of just from an academic perspective, it's quite interesting that over the 70s and 80s, as time went on, people started to think that actually term premia was the biggest driver of bonds, and it wasn't so much what short-term rates would do. And so they kind of believed that bonds followed more the random walk hypothesis, which I kind of mentioned at the top. Almost as soon as they started to believe that, term premia collapsed to zero. And so the yield curve has started to move much closer to the pure expectations hypothesis, which is that it just reflects, the central bank path of short-term rates. So you often find these kind of swings, just as somebody, accepts one, it kind of swings the other way around. So you have to be kind of cognizant of that as well.
Thanks.
Sorry, Bilal, I have a question as well. I was wondering, just as a clarification, does negative risk premia mean the same as inverted yield curve?
Technically, no, because the yield curve is made up of a combination of expectations of where the central bank will go plus the term premia. So you could have an inverted yield curve because one reason could be people expect the Fed to cut interest rates and term premium stays constant. Yeah, so if people believe the Fed will cut rates in the next 10 years, then the yield curve would start to invert, even if term premium stays constant. On the other side, you could say, okay, people don't believe the Fed will do anything, but term premium goes massively negative, then the curve would invert as well. So it's an interplay between the two. So an inverted curve doesn't necessarily mean that it's only driven by term premium going negative. It could also mean that the central bank is expected to cut rates as well.
Thank you.
Okay, good. In terms of book recommendations, a book I would recommend that is good for this topic is a book called Expected Returns by Antti Ilmaron, who is kind of quite a well-known guy in the hedge fund space. He's done a lot of really good work on risk premium and such. And this book actually goes through not only bond risk premium, but also equity risk premium and FX risk premium, and explains concepts from an investor perspective. So I think it's a good book to add to your library. And also some of those original papers I mentioned that's in the spreadsheet. It's worth reading those as well. And I'll send you a link to the spreadsheet after this call.
Yeah, and if anyone is sort of really keen to find about more how central banks sort of think about reserves, all central banks publish annual reports. And so often, not always, but often that will give a breakdown and it will talk about how they invest it. And one point I keep making on India is that because they were hoovering up all this liquidity and they pay obviously much higher rates on that than they get on their predominantly dollar assets, if you say they're in treasuries. And therefore it has a knock-on effect on central bank profitability. And central bank profitability is all consolidated at the general government level at the end of the day. So it becomes a fiscal issue. And in some countries, it's very important. And India in the past, the central bank has transferred a lot of money to the government. So yeah, the annual reports give you all sort of clues on that and how close the central banks are to running losses. I mean, it's quite sort of niche topic, but it can be quite interesting.
Cool. Okay, then I think we can wrap it up there. So if you do have any more questions, just ping me a message or an email. I can answer them hopefully for you. And then for the next tutorial, I'll give it a think, but we might start to focus on equities for the next one.